Hey everyone, welcome back to the channel. So you're thinking about buying a rental property? That's awesome. But before you jump in, there's one thing you absolutely have to master. It's not a fancy real estate term. It's not about guessing the market. It's all about cash flow. Seriously, cash flow is the lifeblood of rental property investing. It's the simple, definitive measure of whether your property is actually making money or secretly costing you money every month. And today, we're breaking down the exact formula so you can analyze any property like a pro. So why are we so obsessed with cash flow? Let's talk about it. First off, financial self-sufficiency. A property with positive cash flow pays for itself. The rent coming in covers the mortgage, the taxes, the insurance, everything. That means you're not digging into your own paycheck to keep the lights on. That's the dream, right? Second, it's your safety net during market downturns. If you're only banking on the property's value going up, what we call appreciation, you're taking a huge risk. Because if the market dips, you could be stuck. But strong cash flow, that keeps money coming in regardless of what the market's doing. It provides stability. And finally, that extra cash is your fuel for growth. It's the money you can reinvest into making the property better, paying down the mortgage faster, or saving up for your next investment. Cash flow isn't just about profit today. It's about building real, long-term wealth. All right, let's get into the nuts and bolts. The cash flow formula isn't one big scary calculation. It's a 4-step process. Think of it like building a layer cake. Step 1, you calculate all the income the property could possibly generate. We call this the potential gross income. Step 2 is the reality check. You adjust that perfect world income for vacancies and maybe a tenant who doesn't pay. This gives you your real expected income. Step 3, you subtract all the operating expenses, all the costs of running the property. What's left is your net operating income, which shows the property's fundamental profitability before the mortgage. And step 4, you subtract your mortgage payment to get to your final pre-tax cash flow. We're going to walk through each of these steps in detail. Okay, step 1, income. This seems obvious, right? It's the rent. But you have to think bigger than just the monthly rent check. You have your primary income, the base rent, of course. But you also have what I call ancillary income, or secondary revenue streams. These are things like application fees, late payment fees, pet fees, parking fees, even income from laundry machines if you have them. Now, individually, these might seem small. $10 here, $50 there, but over a year, they add up significantly. Seriously, accounting for every single dollar of potential income can be the difference between a property that just breaks even and one that actually puts a few hundred extra dollars in your pocket every month. It all boosts your bottom line. All right, step 2, the reality check. This is where a lot of new investors get too optimistic. You can't assume your property will be rented 365 days a year. Things happen. Tenants move out, and it takes time to find new ones. So we factor in a vacancy rate. A conservative, market-based estimate is around 5%. So if your property brings in $3,000 a month in rent, a 5% vacancy rate means you should plan on losing about $1,800 of income per year. That's money you're not getting. But guess what? Your expenses like the mortgage, taxes, and insurance don't stop. A higher than expected vacancy rate is one of the fastest ways a profitable property on paper becomes a money loser in real life. This is why having a great tenant screening process and keeping good tenants happy is so crucial. It directly protects your cash flow. Now for step 3, operating expenses. This is the big one. Operating expenses are all the recurring costs to keep the property running. It's important to distinguish these from big one-off upgrades, which are called capital expenditures. So what falls under operating expenses? Property taxes are a big one. You can't avoid those. Landlord insurance, which is different from standard homeowners insurance. If you pay for any utilities, like water or trash, those count too. Then there's maintenance and repairs. Think HVAC servicing, fixing a leaky faucet, lawn care, and if you hire a property manager, their fee, which is typically 6 to 10% of the collected rent, is a major operating expense. You have to account for all of these. I want to pause on expenses for a second because this is a major pitfall. New investors often make the mistake of only looking at the mortgage and property taxes. That is a recipe for disaster. There are hidden costs that can silently kill your cash flow. What if you have to pay for marketing to advertise the vacancy? Professional photos cost money. What about legal fees if you need to consult with a lawyer? Or accounting fees? My biggest piece of advice here is to be conservative. When you're evaluating a deal, use the higher end of estimated expense ranges. If you think repairs will be 5% of the rent, maybe budget for 8%. It's better to be pleasantly surprised than to be caught off guard by a bill you didn't see coming. That was weird. Okay, we're at the final step. You've got your realistic income, and you've got all your operating expenses. You subtract the expenses from the income, and what you get is your net operating income, or NOI. This NOI number is super important. It tells you how profitable the property is from its operations alone, before you even think about the loan. It lets you compare different properties on a level playing field, no matter how they're financed. Then, you subtract your debt service. That's your annual mortgage payment, the principal and interest. And voila! You have your annual pre-tax cash flow. This is the real number. This is the money that ends up in your pocket at the end of the year. Let's make this real with an example. Let's say a property has a potential gross income of $36,000 a year. We take out a 5% vacancy, which is $1,800, giving us an effective gross income of $34,200. Now, operating expenses total $14,000 for the year. Subtract that, and we get a net operating income of $20,200. This property is operationally healthy. Now, the mortgage payment is $18,000 a year. Subtract that from the NOI, and we get an annual pre-tax cash flow of $2,200. Divide that by 12 months, and that's a monthly cash flow of about $183. It's positive. This property pays for itself and puts money in your pocket. This is what we're looking for. Once you're comfortable with basic cash flow, you can level up your analysis with some advanced metrics that serious investors use. First is that NOI we just talked about, net operating income. It's great for comparing properties. Then there's the cap rate, or capitalization rate. That's your NOI divided by the property's value. It gives you a percentage return if you bought the property all in cash. A higher cap rate usually means higher risk, but higher potential return. And my personal favorite for small investors is cash-on-cash return. This is your annual cash flow divided by the actual cash you invested, your down payment and closing costs. It tells you what kind of return you're really getting on your money. If you put down $50,000 and get $2,200 back a year, that's a 4.4% return on your cash. That's a powerful number to know. Let's dig a little deeper into cap rates because you'll hear this term a lot. The formula is simple: net operating income divided by the property value. This ratio is all about comparison and valuation. A property with an 8% cap rate is generally considered higher risk. Maybe it's in a transitioning neighborhood, but it offers a higher potential return. A property with a 4% cap rate is likely in a very stable, high-demand area, but your income return will be lower. Cap rates vary by city, by neighborhood, even by property type. Understanding the typical cap rate for your target market is essential for knowing if you're getting a good deal or paying too much. Cash-on-cash return is so useful because it's personal. It answers the question, what's in it for me? It directly shows you the impact of your financing choices. If you put a huge down payment down, your mortgage is lower, so your cash flow might be higher, but your cash-on-cash return might be lower because you have so much money tied up. If you put less down, your mortgage is higher, which could lower your cash flow, but if the numbers work, your return on the actual cash you invested could be much higher. It's the metric that connects the property's performance to your personal financial gain. Before you even get into a full analysis, there are some quick rules of thumb to help you screen deals fast. The 1% rule says your monthly rent should be at least 1% of the purchase price. So a $200,000 property should rent for at least $2,000 a month. There's even a more aggressive 2% rule for stronger cash flow markets. The 50% rule is a quick way to estimate expenses. It says that, on average, about half of your gross rent will go to operating expenses, not including the mortgage. Now, listen carefully. These are just starting points. They are screening tools, not analysis tools. Never ever buy a property based solely on these rules. You must do the detailed work we just talked about. And that detailed work is called due diligence. Your cash flow numbers are only as good as the data you plug into the formula. So you need a thorough process. You need a financial evaluation. Look at past records, check rent rolls, research what similar properties are actually renting for. You need a market analysis. Is the neighborhood growing? What's the job market like? A physical inspection is non-negotiable. A professional inspector will find issues you'd never see, saving you from massive surprise costs later. And a legal review. Make sure the title is clear and you're allowed to rent it out. Skipping due diligence is how good deals go bad. This due diligence process is exactly how you find undervalued properties, the holy grail of investing. These are properties priced below what they're really worth, based on their income potential. Look for motivated sellers, properties in neighborhoods that are improving or places that just look ugly but are structurally sound. Maybe the current rents are way below market value. When you do the deep analysis that others skip, you uncover these hidden opportunities. You can buy a property for a great price and immediately increase its value by raising rents to market rate. That's how you create instant equity and supercharge your cash flow. Let's talk about some common mistakes so you can avoid them. The biggest one is failing to do your homework, underestimating expenses, ignoring vacancies. It's a fast track to losing money. Next, don't have insufficient reserves. You need a cash cushion for vacancies, repairs, and emergencies. Things will break. Avoid the appreciation-only strategy. Banking solely on the price going up is speculation, not investing. Buy for cash flow. And finally, poor team selection. Your real estate agent, your property manager, your contractor, if they're not good, it doesn't matter how great your analysis was. Build a great team. Once you own the property, the job isn't over. Now you focus on maximizing your cash flow. On the income side, do regular rent reviews. Are your rents keeping up with the market? Don't leave money on the table. Get creative with ancillary income. Charge pet fees, parking fees, storage fees. These small streams add up. And consider offering lease incentives for longer terms. A small discount for a 2-year lease can be cheaper than the cost of a turnover and a month of vacancy. On the expense side, be proactive, not reactive. Schedule regular maintenance. A $100 HVAC service is cheaper than a $5,000 replacement. Invest in energy efficiency. LED bulbs, smart thermostats, better insulation. They lower your utility bills month after month. Renegotiate with your vendors regularly. Get new quotes for insurance and landscaping. And keep an eye on interest rates. Refinancing your mortgage can be the single biggest thing you do to slash your monthly expenses. To make this sustainable, you need a system. Create analysis templates, a spreadsheet where you plug in the numbers the same way every time. Build a database of your market, rents, prices, expenses. Knowledge is power. Develop a professional network of people you trust, and implement systems to monitor your property's performance. This turns investing from a guessing game into a real business. So to wrap it all up, analyzing a rental property isn't a one-time thing. It's a discipline. Mastering the cash flow formula is your foundation. Adding in advanced metrics and a rigorous due diligence process is how you master the game. This knowledge protects you from pitfalls and transforms a speculative purchase into a stable, income-generating asset. This isn't just about buying a house. It's about building a portfolio. It's your definitive path to financial freedom. Thanks for watching. If you got value from this, hit that like button and subscribe for more content like this. And let me know in the comments what your biggest takeaway was. See you in the next video. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.